Good day, everyone. Welcome to this edition of the CEOMastermind.ca podcast. I am super excited today to have someone I call a friend, a mentor, business partner named Bob Gauvreau, one of the best accounting firms in tax advisory business. I'm going to say North America. I think after this conversation, you'll feel that Bob knows a lot about the North American market, not just Canada and the US, but also just good business sense. He'll tell you a little bit about his journey, but it's been an incredible journey, super smart in all aspects of business. I'm just so honored to have you here on the podcast for our learners, our audience to learn from you. Every time you get up and speak, and we're in the same mastermind group, and can you speak? And even though I'm deep into finance, I always learn something, and of course I should, because you live and breathe this. You did a tax brief on a recent tax announcement, which was spot on and something that people don't think about the implications of tax. But we'll get into those aspects today. But thank you, Bob. Really appreciate you coming here and spending time with us today.
You know what? It's a true pleasure, and thank you for that introduction. I feel like maybe we've overhyped the smart. You didn't say good looking, but you could have thrown in all of those attributes. But no, you know what? This is it's an honor. I know you've created a really incredible community, and we have the pleasure to serve a lot of entrepreneurs across North America. So I'm excited to be able to bring the value and knowledge I know to your people, and it's always great to collaborate with you.
Great, thank you. And you must have read my closing note because I was going to talk about all those things. So we won't get into who's who and who you serve and all that. I'll let it come up. And oftentimes that's a lot of confidential, but I know who you serve and the audience, in any industry would know the people that you support. So all this to say is it's going to be impossible to bleed all the information out. Obviously, the accounting, the financial world is massive and deep. There's a ton of learning, but we're just going to dive into a couple of topics today, probably. As always, I have 10 questions. We get through two, and voila, 45 minutes shows up. And as you, my dear audience, know, we try not to go past that mark. But ultimately, and I always tell my teams and anyone that I talk to, and I've been in franchise corporate environments. I've talked to probably thousands of entrepreneurs, probably same thing as you. But what I tell my team is, in God we trust. Everyone else, bring numbers. And we'll talk a little bit about your book. But one of the things that I have found in talking with thousands of entrepreneurs is everybody wants to make an impact, have a free. They start a business for a reason. Whether it's a lifestyle reason or whether they love working 18 hours a day and making an impact, like the Alex Emojis of the world. People say, oh, he's crazy, but that's his zone of love and genius. He is not. He's very smart, and that's what he likes to do. I don't want to work 20 hours a day. But at the end of the day, what's true among all of that is the importance of numbers, importance of cash. So at CEO Mastermind, where I was really focused on the three pillars of why businesses fail and why businesses need to grow. It's always around having a strategic foundation, setting up your structure and operations is pillar two. And then the third one is people. Those are the three main reasons. But there was a research from Harvard, and many research, doesn't take a genius to figure this out, but there really is only one reason why business dies, and why I always say I hate that businesses and dreams die on the vine, is cash. Without cash, it is not a good word. It is not a bad word. It's what you survive. And I think one of the things that people get into that I've seen is you run a business, but then you talk about financials, and all of a sudden the brain gets twisted and people have a block for it. And I think it's just a mental block. Oh, math, I'm bad in school. And people tell themselves that. It's not really true. So, I suspect that might be part of your reasons for writing the book and get you into that. But, the importance to the audience is like every day I check the cash in the businesses that I run. If it's going up, it's okay. If it's going down, I need to know why. Did I purchase capital asset? Did we have a tax bill come in? Like what happened? So I think if there's one thing only to track is cash, because P&Ls can lie, right? We can get into the accounting of things. They can tell you different things, but cash does not lie. So yeah, tell us a little bit about, a little bit of my experience with numbers. I used to be a financial advisor at the bank and won't go into all of that, but I do see it firsthand in both personal and business. And also for the audience, by the way, Bob also helped not just on your business taxes, because obviously if you're a business owner, you as an individual and your family and your business are intricately linked. And there's all sorts of tax structures you can put together to optimize the impact you make on your business, on the world based on how you set yourself up. But I'll let you kind of walk us through a little bit. What inspired you to write, The Wealthy Entrepreneur? I mean, I love the way you structured it. It's 160 pages, easy read, super smart. We'll put it in the show notes as a link for people to find you. But, what was your inspiration for that?
Thank you. What a lead in. Fully loaded. I would say I could have jumped in on pretty much any of those things. So maybe
Please
just
do.
a few things to kick it off. One, we all know the horrible statistics related to businesses failing. And to your point, the number one reason is related to cash. And it's actually 82% of businesses, according to recent statistics, 82% of businesses fail not because they don't have a good strategy, the right people, a good product. It's that they run out of cash resources to be able to keep managing it. So you're right. Profit is different than cash flow. You see here a lot of startups don't make profit for years, but they've got cash flow. That's because they've got investors to be able to support it. There's also businesses that are profitable that don't have positive cash flow. So we can definitely dive into that a little bit deeper. But some of my inspiration for the wealthy entrepreneur and writing that book was based on my journey. So maybe I'll dive in and give you a little bit of context of who I am and why I'm here to begin with. Like many entrepreneurs, sort of made a jump and a leap from going and working at a global accounting firm to saying, the partners that I'm being asked to be partner with are not really the partners I would choose. I'm working with, types of businesses that I wouldn't necessarily choose to be giving advice to. Larger corporations, municipalities, government agencies, they all need audit reports to get funding. We all know that. That's not the area that I really get excited about. I'll give you one example. We were working for a government agency, and about 10 of the former employees of the firm I worked for were now like the senior financial management team that worked in this company all year round. And I'm going in and doing an audit and reviewing their work. I'm coming in for 2 weeks. They do it for, a full year. They've been
Yeah.
working here for years. How am I going to give them any advice on how to run their business better? So, I looked at that and said, I really, really want to work with business owners because business owners make the greatest impact in the world. And if I can help empower business owners with the financial knowledge that they need to make informed decisions, then that is really a passion that I want to follow. And you sort of talked a little bit about priorities in business, and I say this in my book too, and it's not obviously a popular opinion. Profit and cash need to be your number one focus. And we talked about all the reasons we got into business, and I'm with you. I'm in here to help empower entrepreneurs to change the world, and we can do it together. But my number one focus has to be on creating profits in my business. And the reason is the more profits I have, the more I can reinvest in making change. If I don't have profits, if I don't have cash flow, I can't reinvest. I can't hire more people. I can't help more people. I can't make a bigger impact. In fact, it's not sustainable, and likely it's selfish if you're not focusing on profits and your financials, because you're pulling away the gift that you can offer the world and you're minimizing it. So, yes, is the number one outcome we want to have the impact for sure, but the number one focus we have to have is on our business finances. So back to me. I started this firm in 2008 on that mission to empower entrepreneurs. We've grown our team from just me and one employee to now being a team of 105. We serve North America. We have bookkeeping, accounting, tax. We have a law firm in-house. We're one of the few multidisciplinary firms in the country, which is fantastic and a huge value add. We have fractional CFO services. We have business valuations. In essence, we're the one-stop shop for your financial and professional services needs. And we've created that because business owners need it. And that fits and aligns with our mission. So going from 0 to 105 people has been a journey for many of you. And I know we were just chatting about this offline. Once you get to 20, 30 people, you have to have a system, an operating system in place to enforce accountability, especially in today's market. So yeah, we've had a lot of success. We serve the entirety of North America with Canadian and tax services, as well individuals, corporations, businesses of any sorts. About 2,500 of those, and continuing to grow. We're growing it organically at 35% this year, and have big aspirations of becoming a $100 million professional services firm.
Just to your point, because you're right, a lot of people talk about profit and I want to help the world, or make an impact or solve and true. Like even nonprofits need to make money, right? Like, so at the end of the day, if we think about what is cash to a business to what is food, water, and air, right? We can go whatever, roughly, right? You can go three weeks without food, 3 days without water. You cannot go past 3 minutes without air, right? And so, and that's if you're a professional free diver that can hold your breath. I can't hold for 3 minutes, but I'll pass out. So if you took it the best of the best, and so I always tell, business leaders and other people I always come across is that cash is like oxygen to a human. What it is to a human, it is to a business. And I think people don't pay enough attention, and particularly in your instance, when you have a lot of moving pieces, particularly in your instance, let's just take your just recent example. You have 105 people that need to be paid, and you have 105 people that can make a big mistake at any point in time that can cost the money some significant financial impact. And so having systems and processes and having everyone dialed in on that is super important. And I also think, when we talk about strategy, the importance of the vision and the mission and your values as your organization is where the lead into the second question is. Because what you just said, I think, alludes to the financial clarity. Like, you emphasize the importance of financial clarity for entrepreneurs. Like, where are we going? How are we getting there? What's my business doing? Can you talk a little bit about, how that vision and how that drives clarity in your business in terms of your vision to get to, that magical mark?
Maybe I won't talk specifically about mine, but about more of a generalization of how what businesses really need to understand as a foundational framework. And really, it's understanding your business model, your business's financial model. And regardless of the type of business, whether you're online, whether you're consulting, whether you're retail, there's really only three components that come into the financial model of creating profit and generating net returns. One is revenue coming in. It's interesting. I work very closely with a very highly valued online software company. In fact, it's just had some announcements of being the highest value, specifically in their niche market, value software company in the world. And they haven't turned a profit from what I understand, but they have a lot of revenue. Okay. So revenue is super important. You can only go so long. People are only going to give you so much money if you don't have revenue coming in. And if you're not getting funding, if you don't have revenue, you have no source of bringing money in a sustained long-term environment. So revenue is key. And you hear a lot of people say sales will solve everything. I don't necessarily agree with that. But sales is essential to the long-term success of any organization. The second component of the financial model, again, there's only three, is that there's variable costs. So variable costs are the costs that we incur to deliver any of our revenue. So I'll give you a couple different examples for different industries. One, let's think of like a retail, even like a natural food store. As a retail store, any of our variable costs, our costs of goods sold, those are the products that we buy and sell in our store. We have wages for people who are stocking shelves, cashiers that are necessary to essentially process those payments. We likely have delivery fees. There's maybe some subcontractor costs. There's maybe some packaging costs. Anything that we incur as an expense that's associated with that revenue, we need to incur those costs to deliver revenue. And that one's really, really important. And I'll come back to why in just a second. The third component of a financial model is our fixed expenses. So these are the ones that don't change. Variable costs, they go up and down as our revenue fluctuates. Fixed expenses are relatively fixed. We look at rent for an example. Rent is fixed month to month, whether you sell 100 things or one thing during the month. That's, essentially it's fixed. The rent doesn't change. Insurance cost, maybe some management costs, executive wages, that sort of thing. Even office supplies, they're relatively fixed. Maybe some dues and subscriptions that we have monthly contributions towards, they're fixed in nature, regardless of how much we sell. So those are the three components. I promised you a couple different models, and I only walked you through the retail side. Let me walk you through the consulting side. So an online business that's maybe just consulting services. So any of the variable costs that come into there, that might be some of your direct wages for coaches or your consultants that are working. You might have some travel expenses if you've got to get to and from a business. You might have some direct marketing costs that are lead generation specific to generating revenue. Those are all variable costs in there. Again, once you get your marketing dialed in, it's a really good example of a variable cost because you can essentially identify the cost of generating a new lead or new revenue. I know for us, we've got that pretty dialed in. We can turn marketing up or we can turn it down. It generates our revenue and our leads coming in. So that type of business model is important. We need to understand how ours works because when we break it down this way, revenue minus variable costs is our gross profit. And gross profit margin, the percentage of money we make on each sale, is one of the most important numbers that we have in our business. Now, that is, for example, I'm selling computers. I sell it for $2,000. My cost to put it together, manufacture it, all the components, deliver is $1,000. My gross profit on that is $1,000 and it's 50%. So what I know is that if I sell twice the amount of computers, I'm going to generate twice the amount of gross profit, all at that same 50% margin. And that margin is something that we have to watch as a business owner to make sure that it's not going down. And if it's going down, why? Because that will be one of the very important lead factors of long-term financial success. So hopefully that gives an oversight of what a business financial model looks like. And it's imperative that we understand how this works and how all these components come together.
I don't know who said it, but the idea that sales cures all, I agree with that long term to your point. But in the
Yeah.
short term, to go back up to that piece, I always say that, revenue is vanity and profit is sanity. And I heard
Yep.
that somewhere, or maybe I made it up in a dream. I don't know. I can't attribute it anywhere, but it's something that, I always follow because you see, oh yeah, I got like a $3 million business, but then you're actually broke. And I think it's to
Yeah.
your point, people are not paying attention to the variable and the fixed cost, or they're just paying attention to the growth and say, I'm making all this money, but they're burning it elsewhere in different parts of their business and not paying attention. Rent tripled and not accounting, all these other things, and they're looking at the wrong piece because the P&L has multiple lines for a reason. You're right. There's a couple
Absolutely.
bellwethers, a couple ratios you need to look at, but
Yeah.
there's got multiple lines for a reason. And I agree with you that it has to be the most important thing, particularly people go crazy with their ad cost. For example, like cost per lead, my lifetime value, my CAC versus the LTV ratio. CAC is cost of customer acquisition to LTV lifetime value. These are all true cost of ownership, buying something more expensive, less variable cost long term, higher capital up front. But oftentimes what they don't do is they don't take that same level of rigor on their financials.
Yeah, it should go the other way, right? Like you should get the financials dialed in first before we start getting into minute calculations related to return on marketing. We need to get those finances in place. And I love that. The revenue is vanity, profit is, did you say
Sanity.
sanity?
Sanity.
And then I would throw in the third one, which you alluded to earlier, where it's cash is king. Because, you look at the third layer and everything around the financial model and profit, if you aren't collecting the revenue that you're generating, you don't have any cash, right? And maybe let me just hop into cash for a second as an add-on to the profitability, because this is one of the challenges I see with many of the business owners we work with. If we're only meeting with them annually, which is the majority of the case, business owners aren't that interested in their finances, although they should be. We meet with them annually. We go over a financial review of how their year performed. One of the questions people will ask is, well, Bob, you're showing that I made $100,000 this year. And I say, yeah, it was a great year from a profit standpoint. They're like, yeah, but I don't have $100,000 in my bank account. Where did that go? And we look at the cash flow statement and we go back in and we go, well, you had a really successful year, plumbing business. You started to accumulate that $100,000 in your bank account, and then you went and paid for a vehicle. You went and paid cash for a vehicle because you didn't talk to me about it. And I would never recommend that. Use the bank's money to acquire these assets, and keep that cash in your bank account. But you went and you did that. And then you took, $20,000 or $30,000 out yourself. And then all of a sudden we get to the end of the year. Those really aren't upfront deductions in your business. You've got a big tax bill. Now you're out of money. Yes, you made $100,000. You've got zero cash left. And now you're in a bit of a problem. And that's
Right.
because people aren't managing their cash flow and their cash resources appropriately. As soon as we start seeing profits, we start getting greedier. We go, oh, well, we're making more money. We need to take more cash out. Well, that's not necessarily how that works. And I usually call this the wind from the west sort of metaphor, right?
Mm.
Where if we're not making enough profit and we're not managing our cash resources appropriately on that profit, if the wind blows out of the wrong direction, we get caught off guard. And next thing you know, we're out of cash. And that's where,
And
those
quick too sometimes.
82% of businesses that fail is because that happens. It's not that they don't have a great business. It's that
Right.
they weren't paying attention to the metrics and certainly not paying attention to the cash flow.
I've read Warren Buffett's book and when I did my MBA, and like the number one thing that he looks at in buying a business, guess what? Cash flow, right? The discounted cash flows, and maybe we won't get too detailed on discounted cash flows, but obviously $5 in a year from now is not worth $5 today, so you discount it for future cash flows. But and that's another nuance to think about your cash. But at the end of the day, it's like what's happening this month, this week, depending on the size of your business, but regardless, I look every day. But yeah, you're right. Cash is king. And I would say, I won't say the company, but my brother worked for a public company, and he had joined it recently. And within 3, 4 months of them working, everything looked fine. They were a listed company on the TSX. There was some funny accounting stuff going on, so it looked better than what it did. But guess what? The owner, president, CEO, and the CFO somehow never looked at cash. And when they looked at backward, they just ran out of cash. This company that had like 400 trucks on. It's not a small company. It's a large 9-figure company, and at that size, you can evaporate really quickly. And even if you're a quote unquote small 7-figure business, the impact to your family is massive, right? And so I think it is a fiduciary responsibility that people need to focus on that cash, which I love going down that rabbit hole because at the end of the day, that is the barometer for everything. If you're making good cash, chances are you're making good profit, right? Versus the other way around is not always true to your point based on your expenses. That at least that's what I find in my experience. So
Can I give three sort of tips on cash flow that could make a
please,
drastic impact? I always like
yes,
to give action items when I'm sharing these insights because it's great to talk about it and how important it is, but it's like, okay, well, what do we do about it? So three things that I would recommend for any business listening. Number one, accept all forms of payment. A lot of people and a lot of business owners are like, oh no, we want checks. We'll maybe take direct debit because there's no fees associated, but credit cards, we've got to pay this 3% transaction fee. And we don't want to pay it, especially that American Express card. It's like 4%. And honestly, as a business owner, we need to take the emotional element out of that. Let's raise our prices 4% across the board and let's accept all forms of payment because what that does
right,
is it takes the challenge out of people's cash flow on the other side. And we go, okay, well, we'll accept this credit card payment and then you can figure out how you're going to pay for this later. So
yeah,
what happens is instead of having people owe us money, we're collecting it up front. So our risk associated with not collecting those dollars goes away.
goes
So
way down.
that would be number one. Number two, if people owe you money, go collect it. And I'm a bad example of this because I tend to be a goodwill sort of person where I'm like, oh, I like them. I just want to save their business. And then, I end up having money and sometimes having to write things off if people can't write the ship. But if people are owing you money, proactively go get it. And if you took the amount of money that people are owing you right now and you just went and collected all of that and carried on business as usual, you would double the resources that you have access to. That's essentially collecting, let's just say it's 2 months worth of revenue in 1 month because we're collecting previous periods revenue and the current month's revenue. So go after those accounts receivable. Super important. And the third one would be understand how your transaction events take place. A lot of businesses, including half of mine, we have it sort of split up in mine, but a lot of people are charging at the end of a transaction. And they're charging at the end of a transaction and maybe even collecting 30 days later. Look at your transaction process and say, how can we go from collecting 30 days later to receiving maybe even 50% before we start a project on inception of signing, and then 50% on closing, and be very clear about that. So instead of having all of your cash received, 30, 60 days from now after the project's completed and people pay it, get half of it now, so that it will finance essentially the costs we have to deliver that, and then we collect the remaining amount at the end. Because here's the one thing that we know: when we deliver a product or service for a client and they don't pay at that moment, the risk of them not paying in a future date increases. The reason
Mhm.
is they've received everything that they wanted. There's nothing left for them to receive from you aside
Yeah.
from the collection statement. So as soon as they're receiving that final benefit, that's when we have to get paid. That reduces our risk, and it needs to be part of our process. So if we can move the transaction dates forward, move it from after the transaction to the start of the transaction, let's front load it. And this is where you have a lot of larger businesses have gone out and started selling gift cards. Gift cards are the perfect preloaded front end. Let's get access to all the cash before we even deliver any of the work. It also allows them to plan how much future work is going to be there as well. So those would be my 3 tips. If you implement those, I guarantee you put 20 to $100,000 in your bank account in the next 30 days.
Yeah, I love that. Definitely love the first one. Step out for it. Money's money, and you price for
Yeah.
it. And an actual reality, to your point, depending on the type of business, it's just, I don't know what percent, 50, 60% paid by credit card, or varies. But at the end of the day, if you take it up 2, 3%, you'll actually increase your margin by doing that and have better financial health. So that is a phenomenal tip. Yeah, I agree with the ARAP. Oftentimes I tell people to track your accounts receivable time and your accounts payable. And what I've noticed, unfortunately, is the bigger the company, and this is true for a friend of mine, is a pretty successful consultant, and the bigger the company, the longer they take to pay you. Right. So
Mhm.
the reality is you'll deliver a $50,000 brand plan or whatever, and then they'll pay you 4 to 5 months later. But hang on a second, you're a Fortune 500. What's going on there? Is because they're playing that game of collect money as fast as possible, delay payment. And when you're big, they make percentage on that. Most people are, if you're a 7, 8 figure business, you're probably not going to play that game other than what I think you just said, right? Of get your money as fast as possible. So I totally
Absolutely.
agree with that. It's not enough focus. And I like that you said the last one is try to match your revenue with your cost. So to your point, you're incurring costs to deliver the service, paying your salaries, incurring photocopying if you're a lawyer, whatever. And so you've incurred the cost 90 days ago and you're getting paid. So remember we talked about MPV. It's that money's actually worth the last 3 months, 4 months later, in particular in the last 2 years with all these interest rates. You kind of want to be as real time as possible. And that's why the whole cash is king is critical, right? Because it's real time. I deliver, I pay, and obviously you have to do sometimes a 50-50 or 30-30-40, or, there's a million ways to do it. The moral of the story is, yeah, I like that you said that. It's a real focus is, yeah, get something up front, and all money it's all the same. I love that, except all form of payment. So,
Yeah,
yeah.
and I think you brought up one point too that I'd love to just maybe jump into, and that's pricing. And I think you brought up Alex Hormozy earlier as well. I think he does a really good job in his $100 million offers talking about pricing and the delivery of pricing. And us as business owners, we have such a stigma attached to changing our prices. And we feel like as a business owner, if we change our prices, we have this fear that if we change our prices, everybody's going to go away. And Alex, in his book, talks about, the value of what you're offering and how you present that to people. And that if you are offering them and delivering more value than what they're paying, they always perceive a discount and they will continue to pay as long as you're not charging more than their perceived value that they're receiving in return. They'll continue to buy from you. And so we go back to the business owner and we say, okay, increasing prices is a reality of everything. Inflation has been high, interest rates are high, uh, employees are more challenging to get higher productivity all across North America. We're seeing our margins drop, we're seeing our interest costs go up. Pricing is essential. And that's essentially what inflation is everybody's been increasing their pricing. We need to do it
Right.
too. So let's get over ourselves a little bit as a business owner and say, let's just better present to our customers the value we're delivering to them. And I'm sure everyone who's listening to this podcast, right, we're a proactive group of business leaders. We're different. We're the top 10% of business leaders that are in here because you're proactively trying to become better by listening to these podcasts. We're the ones who are already delivering more value. Now it's just a matter of making sure that we're confident in what we're delivering and that we better share that delivery and that experience with our clients, and we increase the prices respectively. Because, if we think back to our financial model, right, we're selling, let's use my computer example. We're selling a computer for $2,000. It costs us $1,000. Our profits, is $1,000. Well, if we change the price of that computer to $3,000, we still only incur $1,000 of costs. We're now profiting twice as much by increasing the price by 50%. And the power of that is if you want to scale your business and grow your business and create greater profitability, the number one way you can do that is better price your products, increase the margin in which you're
Right.
generating, and you're going to be able to double, triple your bottom line. Like in this example, there's a 50% price increase and it's 100% increase in my bottom line income. I just doubled my profit right out of the gates. So be aware of that, because now, even though we're self-conscious as business owners going, I don't want to charge more, my clients are going to be unhappy, they might leave me, oh, poor me. Well, let's better, demonstrate the offer, what we're bringing to the table, because guess what? If you increase your prices, you could double down on what you make. And I think if we all understand we're doubling down on what we're making, we can reinvest our profits, help more people, and make the change that we really wanted to. So pricing is a key component to long-term sustained financial success and impact as well.
Yeah, I love that you said that. I can go down the pricing rabbit hole. It's one of the most difficult topics for most people, but it's one that I actually love because I always like to think about pricing is, like you said, about value. So what is value is benefits received for price paid. And I also believe in most businesses because you're going to have inflationary costs at all points of your P&L. But I'm a believer of you price every year, right? You price every year. However, through productivity, you increase the value that you deliver. So if you're taking your top line, so for example, rather than waiting 5 years to take a 10% increase, 2% per year feels a lot more palatable, increases your cash flow and the value of that money in your business. And I also think people should be focused on how do I, leverage technology, automation, systems, whatnot to deliver productivity so you can get your cost structure more optimized. So you don't have to bloat your organization to chase that revenue, but then find out ways to deliver value that might be high value to the customer, but low cost. So sometimes people bring back an old product. Oh, we'll throw in this course for you. Guess what? You already spent 20 grand making a course with videos. It's a sunk cost. There is no cost anymore. That's it. It's done, right? So it's literally a value that's worth lots of money to substantiate. So always looking at, let's say in a membership model, keep increasing your prices, but adding more value into it. And as long as what you add into it, so if you take your price up 3%, but your cost up by 1, you threw in more perceived value, you're still better by 2%, right? And
Yeah.
to your point, if nothing else changes, it trickles down to every single P&L line down to the bottom often, right? Which is, to your point, how you just double your business. The other one that people forget is the effective elasticity, right? So, what goes up must come down. Doesn't always happen. Some things are more elastic. So if you take your price up 1%, and your volume goes down 1%, that's a 1-to-1. If you take your price up 1% and if your volume goes down 2%, that's an elastic reaction. So it's a 1-to-2 ratio. Most times, our emotional fear, overjudges that. But in reality, even if you did lose some, but if you're making more money on less customers, isn't that a more simplified business that you can then hyper focus and reinvest back in your business? And I think that when people say, I can make 50% more, lose 30% of my customers, and I can serve those 30 way better than I did before, which means you can charge more in the following 2 years or give them more value, more impact, and create a stickier long term.
It's super interesting, and there's a lot of power in actually calculating that out, right? So if once you understand your financial model, you can play with pricing increases and you can play with the risk of loss because if you're charging more, and let's just say you're charging a more appropriate value. We're not talking about price gouging. We're talking
Right,
about
exactly. Different.
getting the value out of what it is that you're delivering and getting paid your fair market value, to be honest. And if you're not charging that and it's a decent bump, there could be loss because people are just shocked in the discrepancy in what they've been paying versus what they have paid. And truthfully, I've gone through that experience. We've acquired an accounting firm in the past that was charging less than what I was paying my qualified staff to do it because they didn't have good people doing the work in a previous experience. So I had to bring in my qualified people, and we had to charge more because it was done right and better. And so people, because of that gap, where they had sticker shock, and some of them moved on. A lot of them came back because they went, "Oh, you guys are actually really good at what you do, and we should have been paying this all along to get it done right." We go, "Yes." Um, but the idea, back to your question, the idea is that if we're, increasing our price 5%, let's say, and we lose 5% of our customers as part of this, we're making more, as you suggested. But just think of, the idea of pricing increases and losing business as even making the same amount of money, but doing much less work. So sometimes we have to look at our lower level clients, and everyone's heard the 90-10 or the 80-20 rule, that 90% of your clients take up 10% of the work and 10% of your clients take up 90% of the work. Sometimes we have to look at that 10% and say,
True.
they're going to probably be the price sensitive ones anyway.
Yeah.
So if we go and increase the price and we lose that 10%, but we're making the same amount doing, 10% of the work of what we did before, isn't that a better business? Don't you have more energy and time to build it and help more people beyond that? So yes, I love your perspective on that. Couldn't agree more. And just know, guys, that we can actually calculate that out. As you go and change a pricing strategy, we can calculate out scenarios that say, okay, if we were to lose this business, are we still better off or worse off? And we can project that and come up with scenarios of how we can react to those changes. So lots of goodness there.
Yeah, it was just the tax. So just to wrap on the last one, 70-20-10 is a ratio I've looked at. So the 10% bottom, I think we can spend 5 hours on pricing, which we won't. You've talked a lot about on stage about taxes, and that is oftentimes people will spend money to save the taxes, and really it's like a fallacy of thinking. Can you talk a little bit about that? Because that's obviously a cumbersome piece. There was a structure you mentioned once in terms of setting up a trust, and that might be too complex in the last 10 minutes that we have here. But can you just high level some tax and some tips and whatnot in the tax? Again, we're not doing it service here. This is just a little wet the whistle, and I think we're going to encourage
Yeah.
the audience to dive deep with you. Reach out to me. I'll connect you with Bob and his team. But like, pay attention. This stuff is game changing, like literally game changing. All these topics today. So in terms
Yeah.
of taxes, yeah, like just give us your top 3 tips or your experiences.
So to answer your first question, there are some misconceptions that are out there. Probably the one that I get the most is what should I spend money on to save tax money? And I usually say spend it on me. I'll save you tax money. No problem. I'll take your money and I'll pay the tax on it. And here's why. In Ontario, across Canada specifically, the small business tax rate's 12.2% for the first 500,000. In the US, we're at 21%. Federal tax, depending on the state that you're in, it'll fluctuate from there. So those tax rates are okay. we always want them to be lower and we continue to fight for that, but that's okay. So here's the reality. Let's use Ontario for an example, 12%. If I give you $100, it wipes out $100 of income. I don't pay my $12 in tax on that. No problem. That's what people are asking me. And instead, I say, okay, give me the $100. I'll take your cash of $100 and I'll pay the $12 in tax on it, but I have $88 left. What do you have left? You have $12 in tax savings. I have 88, you have 12. So that's not really the right approach, and that's not really the right answer in saving tax money. So there are quickly a few strategic ideas that you can implement that will actually save you money and put it back in your pocket. One is don't just spend anything just to save taxes. Don't follow the Grant Cardone philosophy of buying a private jet and expensing it in your business. It doesn't work. Let's keep our cash. Our cash is super important, as we've talked about. We'll minimize our tax in the best way we can. So strategic timing is very important as far as business expenses go. Let's say your business year is January to December, if you need to buy something and you think it's coming up in March, buy it in December. If you buy it in December, we get access to the deduction right now. You had to spend it anyway. Let's start getting access to those savings now versus a year from now. So strategic timing is good. Income splitting. My kids are 16 and 13. They're actively involved in doing administrative items in my business. They can also receive $15,000 each without paying any tax. I get a full deduction in my business. I save $30,000 or I get a deduction for $30,000. They pay zero tax to get that out, where I would maybe pay 40% tax to get that out. So, strategic little initiatives like that. Let me say this though. Overall, the greatest loss in paying too much tax comes from two situations. One is your business structure is not correct. I talked about the business structure of a corporation in Canada, 12% tax. In the US, a C corporation is 21% tax. If you are paying higher tax rates than 12 or 21 on your personal tax return, your structure is not as efficient as it could be. You need to look at a corporate structure for a lot of other reasons, but for taxes, it's 12%. If we're not making 12% or paying 12% tax personally, we have to look at a corporate structure. The second is how you get compensated as a business owner. You can take out dividend distributions or salaries. There is a better way, one over the other, dependent upon your situation. In many cases, it's allowing the business to pay tax at its corporate rate, and whatever money you pull out, you pay dividend or distribution tax on it. It's going to be more efficient 99 times out of 100. But you need to look at your situation and say, let's evaluate which way is the right way for us. So those are really the primary areas where we see a lot of lost tax money, wrong structure, wrong compensation, spending money on things that they shouldn't be, and not being as strategic as they could be, and taking advantage of all expenses that are available.
I really urge the audience to really take this seriously, right? Because the financial aspect of your business is literally the core to everything. You've said it earlier. It's like you have to have that dialed in. How am I making money? What value am I giving? What are my costs? And how do I set myself up to optimize not just your take home, but also your impact? Because if you go out of business in 3 years from now, guess what? You're not making an impact. Here's a crazy fact. I'll end with this. To your point, it's 82% of companies in decline. I think it's something like 72% or some crazy high number. Like depending, I hear 60, I hear 80. Let's say it's 75. Doesn't matter. Doesn't change the moral of the story. Of the Inc. 5000, so America's fastest growing companies, 70%, 7 out of 10, disappear after 3 years. Why? They were so good to grow so fast, but why did they disappear? And we know the answer today. Right? It's cash. They weren't paying attention to the right thing. And I think the one thing I really urge people to do is a professional athlete, right? Don't they have a team of coaches, right? They have people like Sidney Crosby cannot be who he is, McDavid, Austin Matthews, all these superstars, any Olympian, they have teams of people. As business owners, we're Olympians in the game of business. And so people like you are the coach and the support staff. to watch for the blind spots. I mean, even if individual sports such as cycling has a team of people behind them, their nutrition, their fitness, the doctors. Like a friend of mine's a hockey player. There's like an army around one person. They get hurt, and it's like all these people come on. So at the end of the day, think like an Olympian is what I always say. You need a team of people. You know, we as business owners and leaders need people like you. And I cannot stress to the audience the important. How many times I've had conversations with an accounting firm. Yeah, but you got to get a legal opinion on that. Okay, now I got to go to the market. I got to talk legal opinion. So I think it's super smart what you've done. You've obviously identified a need that's been, you know, sorely missed in the marketplace. So kudos to you for, you know, a beautiful brand expansion, wonderful entrepreneur stories. Not always easy up, downs, and sideways as they always are, but I think the impact you're making, the people that you're helping, I'm so honored to have you here today. Share some of your wisdom. I'll put all the show note stuff in here, so we'll get the links out to people. And really deeply appreciate you as a man, as a father, and as a friend, and sharing your wisdom with us. So thank you so much, Bob.
Yeah, my pleasure. And honestly, guys, you know, as I shared, my mission is to empower entrepreneurs to change the world. And together we can do just that. If I can help support you, your business, the financial power that you bring to the table in any way, feel free to reach out. Our team is here to do just that. Thank you for listening and having me part of your show today.
Yeah,
Love the opportunity to connect with your audience.
awesome. Thank you so much, and we'll see you in the offline.